Hello, everyone, and welcome to this Edison interview between myself, Elliot Burstock at Edison Group, and Richard Stavely, Fund Manager at Gresham House Strategic. As an introduction, Gresham House Strategic is an AIM-listed closed-end investment company. Richard and the team employ a differentiated style to investing in UK small caps. It's a concentrated and engaged approach with typically 15 to 20 holdings. The company has a good track record and has outperformed the AIC UK small company sector over the last 5 years. As of today, the 9th of October, it currently trades at a 20% discount to NAV. Both the board and the team have recently bought shares, and I'm delighted to be joined by the lead fund manager, Richard Staveley. Richard, hi, how are you?
I'm very well. Hi, Elliot.
Yeah, hi, Richard. And as I mentioned in the introduction, it's a differentiated approach, and we have a slide here from your recent presentation. Can you explain what is strategic public equity and also your investment philosophy?
Sure. So, strategic public equity investing is really trying to deploy a range of private equity techniques to publicly listed companies. What that means in practice is that we have a highly engaged strategy, as you mentioned just a few moments ago. But what we're looking to do with that engagement is really drive strategic, operational, or management initiatives that we agree with and identify with the management and board of those companies to unlock and grow shareholder value. This does tend to lead itself to businesses that have recovery opportunities, but not exclusively. Private equity typically try and buy 100% of the companies they're involved with and have total control. That's impossible in public markets. So instead, we seek to take influential minority and significant stakes in those businesses, usually between 5 and 25%. And then alongside that, we look to develop a positive and constructive relationship with the management teams and boards of those companies. Often we will suggest board candidates, as with the natural evolution of boards, people that we know and really understand shareholder value, or people that we've identified that we think can really help that business with its issues or with its future. I think we target a really exciting part of the UK stock market now. This sub £100 million area of the UK stock market. It's very inefficient, and we think that it's structurally overlooked by the rest of the market. Lots of fund managers just don't go down to those levels of market caps, and when they do, they're often looking for very high growth businesses these days, rather than those which have issues to sort out, challenges, or are recovery opportunities. They're also very poorly covered by the sell side these days and broker research, and as a result, we think you can find really outstanding investment opportunities there. We, like large swathes of the private equity market, use a valuation-led approach. We target undervalued businesses. Now, some parts of private equity obviously look for unicorn hunting and very early stage type businesses. That's not what we're after. We're after cash generative businesses and businesses that can generate a lot more cash in the future through those initiatives we've identified. I think I labour this point because at the moment in markets, there is, in our view, a quite significant crowding into high growth, high valuation stocks. And we do offer an alternative for people who are considering whether that trend will go on forever, will extend further, or whether hedges are required. We like private equity. We do significant levels of DD. It can take between a month to up to 6 months to DD a company. We talk to suppliers and customers, reference management extensively, and we're able to do that because we have less holdings. So you mentioned we were concentrated. We actually have a maximum of 20 holdings in the trust, and at the moment we've only got 15. So less holdings, and then we use this due diligence phase to reduce the risk of that concentration. That's helped by the fantastic platform we have at Gresham, where we've got the Baronsmead VCT capabilities and insights into the private companies they back, and the wider resource. Just finally, we have a flexible mandate. We can invest across the capital structure. So we do, and indeed currently have, 3 bonds, 2 of which are convertible bonds, which we use to both increase our influence with that business and also de-risk our overall exposure to the economics of the business. Currently it's 12%. And again, investors that don't know, should know we're not looking to invest in early stage or businesses in that unquoted phase. It's near to IPO or bonds is the main focus. Just to touch on our philosophy, which is behind that overall approach. What we're looking to do is target profit recovery and accelerated earnings growth. A company that's fallen on either strategic difficulties, or the management are changing or need to change, and to produce better operational performance. And that process, usually at that point, the shares are pretty out of favor, derated, and it all seems too much like hard work for many investors. But that's actually an opportunity for us, and we see the opportunities for rating expansion, and also with that eventual profit recovery, cash generation, often significant de-gearing, and then we try and identify catalysts, de-risk that whole process. We get involved on a range of things. So we might be involved in the actual capital restructuring that takes out a lot of risk to that recovery. We've recently helped refinance RPS PLC, Van Elle PLC. We put money into Bonhill PLC most recently. Secondly, we do, as I've mentioned, get involved in board changes to help the businesses. Recently, Stephen Yap joined the board of Northbridge Industrial Services. We introduced him to the company. Earlier this year, Sir Roy Gardner became chairman of Pressure Technologies, one of our significant holdings. And we also help the business through corporate advisory work, introducing them and helping them meet people in our network that we think can help and enhance both the business and how it engages with the market, and how to actually engage specifically with the market through IR and PR improvements.
Okay, great. And why are you excited about the opportunity now?
Gosh, it's just a multitude of things, Elliot. The first point would be, the shares trading on a 20% discount is just, I just think is just, great opportunity. And the reason for that is that the portfolio itself is super cheap. We're on 5.8 times EV/EBITDA with almost, it's like 0.1 net debt to EBITDA. So it's, on average, it's an unleveraged portfolio on less than 6 times EV/EBITDA. We expect significant NAV growth over the next few years, driven by the holdings. We've announced an enhanced dividend this year. We're guiding to 27.5p. So the running yield at that 20% discount is a 2.8% running yield, which is a good place to be whilst you're waiting for that NAV growth or discount to unwind or come through. We think that our stocks are undervalued, obviously, materially. The UK's out of favour, small caps out of favour, and we've been deploying significant amounts of capital during this crisis. One of my favourite phrases in the market is taking the opportunities of a lifetime in the lifetime of the opportunity. Well, it's kind of this year. So we've deployed 36% of the portfolio over the last 12 months into some fantastic stocks that we think will all at least double, and hopefully quite a lot more than that. Our largest holding, critical to the outlook for the vehicle, is Augean, but 26% of the portfolio in that has a fantastic outlook, and I'll maybe touch on that if you like later. We have 20% in cash and bonds. That means we're well financed, and we've got the ability to deploy in this final stage of this year where we think more companies are going to need more financing support. And a number of the positions are now maturing. So we've gone through, as you mentioned, the 5-year anniversary. A number of the holdings are coming into a phase where we're expecting exits, either to trade or to other interests, which should drive NAV growth. And I think finally, just the portfolio itself has no distress. So we haven't got anything that's in serious trouble. It's well capitalized. So we think this is just a great opportunity right now.
Okay, so you've mentioned some of the companies that you are invested in. We've now got some case study slides. So which of your investments would you like to talk about the most, which really demonstrates your investment approach?
I think I definitely need to talk about Augean. It's a concentrated portfolio. Some investors will be thinking, gosh, 25, 26% is a significant amount. But we would point you to our understanding of that business, the due diligence we've done on it over a number of years, and our understanding of where that business is in its investment thesis. The company is the market leader in hazardous waste in the UK, has about 40% market share. It's on an EV/EBITDA of about 5.5 times. The sector trades, and transactions in the sector, M&A transactions, of which are a number of recent examples, happen between 8 and 12 times. It's proving to be a very resilient business this year through COVID. Profit was slightly down, but the core piece of their profit growth over the last years in terms of treating fly ash from energy for waste plants has been in growth. They are now making 22% operating margins. When we got involved in the stock of 3 years ago, profitability was much lower. We were involved with management change and a de-risking of the business. The management have done an outstanding job. It now makes very high returns on capital. And equally, our ability to spend a lot more time than the average investor on due diligence allowed us to work through the risk reward around an HMRC claim that the business received a few years ago, which caused the shares to collapse. We're now actually about to hear the first hearing on that case coming through in the final quarter of this year. However, the business has already put into escrow over £42 million to pay any outstanding claims against it, and we see it basically being an upside event only going forward. That business, as a result, we think is undervalued. Its returns are already outstanding, and its growth and returns should continue to improve, and its balance sheet is going to move to net cash. So we expect a dividend next year, which for GHS shareholders will be fantastic if we receive that, and may, in our view, encourage a number of other investors to reappraise the opportunity there. I think the other stock that would probably be a good example, again, historic, would maybe be IMImobile. And I just use this more as a case study of how we go about doing things. And also for those that have maybe followed GHS over a longer period will know that IMI was even bigger than what Augean is now. In fact, it got up to over 40% of the portfolio at one point. We've now fully exited IMImobile during 2020 and redeployed that money into fantastic COVID distressed positions. But IMImobile was a really good technology company. However, trading on about 6 times EV/EBITDA when we got involved with it, where peers trading valued much higher, and indeed the intrinsic value of the business significantly higher than at that point. They had a number of things which we felt were holding it back. They had quite a complicated share structure, which we helped advise them on in cleaning up. The chair, who was one of the founders of the business, was based abroad, and we introduced and helped evolve the chair to be maybe more palatable to UK-facing institutions. and we helped them with IR and indeed advisor. There was an advisor change as well. The business has gone on to explain itself much more clearly, execute better, and during our period of ownership, it re-rated from 6 times EV/EBITDA to 12 times EV/EBITDA, and we've now locked in an IRR of 23.7%, if I remember correctly. I think it's important though, because for those that are still wondering, gosh, how are they going to exit Augean in these illiquid small cap markets? Well, if the company doesn't receive a takeout or other interest in it from off the stock market, IMI is quite a good example of a company we've managed to exit our position into the secondary market without really impacting negatively that re-rating of the business. Just finally, a touch on Van Elle, a company we've helped refinance this year. There we're backing a new management team that we have high hopes for, led by Mark Cutler, ex-Balfour Beatty, who's come in to help professionalize the operations and way they go about business internally, improve their capital allocation decision making, and drive hopefully organic growth over the medium term. We've got a new finance director has joined the business as well, who's outstanding individual who's already massively improving their internal management information and financial position. And he actually announced a couple of weeks ago that they had secured a new lending package, asset-backed lending package to support the business. I should have said, apologies, the business is a piling and foundation company. Apologies, I should always do that first, shouldn't I? But it's one of the leading companies in the UK, if not the leader in foundation and piling for construction development. It's specifically the leader in rail, which really excites us because HS2 has been signed off, and there's also the CP6 electrification program going on, and that will create quite a lot of opportunities for this business, alongside wider infrastructure spending, which we expect to pick up over the next few years. The business has an opportunity to significantly improve its margins, generate significantly more cash, a better ROCE, and we expect it to accelerate its organic growth rate over the years ahead.
And just coming back to GHS, can you remind us of the dividend policy, the cash position, whether you employ any discount control mechanism, and also the performance?
Sure. So we've been growing the dividend at 15% a year, in line with our targeted IRRs for the portfolio. This year we've increased it to 20%, and that really reflects the board's confidence and our confidence in the outlook for the portfolio. We have a decent level of income coming in from the bonds, and almost all our companies are either have been dividend payers or have the potential to pay out significant amounts of dividend in the future. And then we supplement that from the realizations that we make during each year. So we're comfortable with a 15% growth rate, at least for the next few years. In terms of cash, we've got about 10% in cash now, and we would be looking to deploy into another significant holding, hopefully between 6 and 8 of that, hopefully in the next final quarter of this year. And we've got a number of pipeline investments that are nearing the point of execution in that regard. There's no official discount policy at this point. We have tactically used buybacks over the last few years, and indeed we did that last year as well. We're trying to let and hope that the performance does the talking, if you see what I mean, and that we can use that to drive in the discount. We had been much narrower earlier on in the year, and it had come in pre-COVID. So we do think that it's an opportunity, and we're doing everything we can to try and bring that in now. And in terms of that performance, since inception just over 5 years ago, it's been pretty hard work for small cap. The FTSE small cap index is only up 1.8% since we started the strategy. However, GHS is up 36%. We've just gone through the 5-year anniversary, as you noted. We were ahead, more than 23% ahead of the index over that period. And I think it's fair to say that we took over the strategy. There's an element of sort of seeding and then maturity to the way we invest. So the 3-year numbers, as things start to mature, showed an acceleration of performance with GHS now up over 20% versus the market actually down 19% over the last 3 years. I think what's also worth pointing out is that although value, which we care about, is deeply out of favour. I mean, this year we're down. The NAV is down 13%, but the market's down 22%. So we've significantly held up despite a value bias, and I would say just goes to indicate some of the ways people are describing value performance may not, you can navigate that, and we are doing that now.
Okay, great. And what's the outlook for the investment company? Do you have a longer term goal? And I guess what I'm asking is how big could the company get?
Well, we could run significantly more AUM. We currently have about 50 million deployed in this strategy overall, and we think we could run up to 200 million in this strategy, and we would seek to grow GHS if we were able to get to NAV or other entrepreneurial ways if we can as well. I think in terms of the outlook overall, it was I think it was Einstein that said, in the middle of difficulty lies opportunity, and that's where we are right now. It's clearly a difficult situation for markets, for governments, for many individuals, but the biggest determinant of future returns is entry valuation, and UK equities are very good value relative to history and to other markets and to other asset classes. The small companies effect over the long term is outstanding, and kind of no one can argue with that. Over the long term, it's been fantastic. But the size discount, particularly under 100 million, has widened out this year. It's large versus history, and we expect that to come in, and that would supercharge returns. The value factor's out of favour, and its underperformance is stretched versus history. That could further add fuel to the fire. We think that the structural factors that support this strategy, this lack of interest sub 100, actually intensified post MiFID II, meaning there's even more opportunities for us to look at. And because of COVID, there's significant market dislocation. So our pipeline basically full of opportunities. We've now got the resource and capacity in place to execute this strategy. It's a nimble fund. We've got a very experienced investment team, investment committee, and wider skill sets at Gresham, which we're utilising. And we do think there's going to be material catalysts in the portfolio over the next 12 months. So my kind of outlook right now is that PE and trade buyers are clearly all over the dislocation now between what they understand value to be versus what public markets are putting on some of these businesses. It's not, I think, too ambitious to think that in a relatively short time, remember, we're looking to make investments that make us and our shareholders lots of money over the next 3 to 5 years. So it's not unrealistic to think that in that time horizon, number one, there will be an effective vaccine rolled out to those that need it. That secondly, Brexit will have passed, agreed, and be a historic event. The effects may be negative, but that will have occurred. And although society is going to have this debt load burden for some time, which we all have to be cognizant of. The UK remains, a very vibrant and much more entrepreneurial place, actually, I think, than it was 20, 30 years ago. And I think there's, a great opportunity set to going forward in the UK.
Okay, well, that's a nice, positive and domestic note to conclude the interview on. That just leaves me to say, Richard Stavely, Fund Manager at Gresham House Strategic, thank you very much for your time.
Thank you so much, Elliot.